Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point with True North Wealth Partners. I'm Andy.
Eric, Susie.
And episode number 20, 2222.
Nice. Oh, we're going to the Vegas. Let's go. Roll the dice.
That's right. Only time we can say that, right?
Right.
Yeah, a little rainy out there today,
Yes,
but
at
least it's not snow.
No, it's coming later in the week. Another batch.
Oh, that's
lovely.
perfect.
I know. Great. And my poor aunt's coming in from Arizona. It's
Just in time.
give relief for my parents. It's like, oh, man. Anyways, good to see you. Everybody all right?
Yeah, everybody's good, I think.
Cool. Yep. Likewise. Just hanging in there. That's a blur. Can't believe end of February, right?
Grinding away, yeah.
Get through March and then springtime. Well, how are we looking on all the?
Yeah, getting slammed out there.
Yeah.
Getting a lot of red this year. Isn't there?
Oh yeah. No question on the markets, but
A lot of volatility.
as far as we get into the sort of openings, it's a little back and forth right now, ebb and flow. But how are things looking on the first Stratus reopener? There?
Yeah, things are looking good. Improvement really in everything. Looks like everything that they're continuing jobless claims, weekly retail sales are up. Jobless claims down. Box office receipts are better than they were last year. Retail car traffic up, steel production, hotel occupancy increasing, open table increasing. Right. People are eating out. It seems like with the restrictions being lifted, people are trying to enjoy life again and get back out and do the things that ultimately they enjoy, but ultimately too helps kind of drive the economy, right?
Amen. Yep.
So.
Yeah. Reopening. Yeah. Drop the mask.
Yeah, it looks like that.
That's good.
We're heading that way. So yeah.
All right. Well, today we'll get into a lot of, like you mentioned earlier, a lot of red first 2 months of the year, but sort of what we anticipate. We position our portfolios.
That's right.
For that. So
you can be the bad news. You be the bad guy. I'll be the good guy.
Excellent. That's fine. I'll roll it out to you, folks. You know me. We just keep it real as best as we know, right?
That's right.
And then you can bring some sunshine here. All right. So getting into it, let's just hit a few things. So Bank of Atlanta, the Federal Reserve, just came out on 2/17 for their latest Q1 2022 quarterly GDP nowcast model of growth of now only 1.3%. So growth's been going down. If you recall, folks, we had 5, 6, 7% GDP growth for over the quarters over the last year and a half or so. So now that's peaked. So Hedgeye, NDR Research, Argus, all of our research partners that we use. So Hedgeye just got off the call today. So again, November of last year, 2021, was the peak for growth. So that was the peak for growth, good times. This gets harder from there. So that's number one. Number two, we talked about Bank of America, Bank of Atlanta, GDP, 1.3% Q1 growth. That's the nowcast for right now. So nothing 3, 4, 5, it's 1.3% growth. Then CPI, consumer price inflation. So we believe, meaning, again, Hedgeye is on the call again today. He just reiterated, he predicts, based on all the forecasting and things of that nature, parts that make up, shelter, rent, housing, all that, oil, those are the leading or things that really hammer or affect CPI the most, are those. But other parts of the inflationary components are rolling over. So now all will still be, some will be still going up, some will be elevating and going back down and rolling over. So think of a roller coaster coming to the hill, coming back down.
So that's good, right?
It's great.
Yeah.
Great news. So we believe, and he believes that from Hedgeye, again, I'm researching this coming from them, that the peak is in February. Now, this is the month. So 7% now down to upper 4% by the end of the year. So if you blend it all out, it might be 5.25% for the year for 2022 versus 7.5%.
Sure.
CPI for 2021.
And the Fed hasn't done anything with
Nothing.
rates.
Fed hasn't done anything yet. So you hear Goldman and JP and all these other firms. Oh yeah, 5, 6, 7 times rate increases ain't gonna happen. So I'll tell you that. So they can't. If they did, we'd be in a recession. So simple as that.
Sure. So yeah,
we're just common sense folks, but we get that. So it's a lot of talk. And that's what they do at that level of.
Yeah, they make a lot more though than we do.
Yeah, they do. Yeah. We live in a van down by the river.
And I live in a van down by the river.
I love it. Anyway, so that's some stats on that. NDR, Ned Davis Research, and as FactSet, as they've also mentioned this. So Q4 earnings, have come and go for the most part.
Sure.
They've been pretty good thus far, but however, it could be the lowest Q4 earnings since Q2 of 2020. So it's all about rate of change. So we peaked out. It's getting harder and harder to keep those earnings as high as they have been. So again, everything's peaked out. So that's just coming from them. I wanted to point that out. Mm-hmm. But more importantly, me, I learned this, T. Rowe Price, all about forward guidance. So forward guidance is not all pretty, folks. So that's why the markets are also jittery.
Yeah.
So forward guidance hasn't been as good and getting and setting up for a lower GDP forecast for Q1 and Q2, et cetera. So again, those are all what's happening within that. Mm-hmm. And going back to the ROC or rate of change, again, March, April, May of this year, 2022, March, April, May, compared to last year, 2021 of March, April, May, the comps, that was the best in the rate of change. So we're coming up high down to low, and the worst will be April, again, coming from Hedgeye. They track all this on a daily, monthly, quarterly basis, things of that nature. So meaning the Fed wants to start raising rates into a slowing economy, the rate of change, and nothing ever comes well. And I'll leave with this as far as why you and I have made this call and put in a little more defensiveness to our models, things of that nature, is because Hedgeye has not missed a quad 4 call since its inception. So, since they've been doing this. So they've nailed every quad 4. So remember, 1, 2, 3, 4, quad 1, 2, 3, 4, spring, summer, fall, winter. So we're in quad 4, which is winter. Things are turning over. It gets harder. So again, first half of the year, a little more challenging, choppy. Back half of the year will turn up, and especially in November when things get better. So, so that's just a quick little summation of that. But anything you want to maybe add in before I?
Yeah, no, I was just going to reiterate, some of that. Like today, Home Depot had their earnings release, right? Yep. So they beat expectations. Yeah. Everything looked good, but their forward guidance is not as good. So.
And what happened with that?
They were down 5%.
10%.
Or
10% now.
Pre-market was 5%.
Yeah. So now it's down, but to your point. Yeah. So it's amazing. That's a great example. Thank you for bringing that up. So spot on. So it's all about forward guidance. It's already been baked in. That's old news. By the time it comes out, a month or 2 months later, who cares? People are selling into it. So that's what we've been doing.
Yeah. What? Yeah. Yeah, and plus too, right? There's a lot going on with geopolitical stuff.
Yep.
Primarily, so you have, and that's what we're seeing right now.
That's exactly right.
The Fed is one thing, but what's dominated the news over the last few weeks has been Russia and Ukraine.
Correct.
And so it's just, and the market is gets jittery. There's these geopolitical events. They tend to drop the market short term.
So to your point, Andy, exactly right. So Russia, beyond the sanctionings that folks are going to be doing, and the United Nations, et cetera. So because they're trying to annexing 2 more regions in eastern Ukraine, that's what occurred just yesterday or what have you. So again, it started when he annexed in Crimea. That's part of Ukraine down by the sea there. So he took that back in 2014. Okay, so when you don't have strength, a lot of weakness was going on back there in 2014. The point is, he's doing the same playbook. So that's what's going on with Russia. He took 2 more annexes. He's got 3 states within Ukraine. Will he go further than that? Who knows? But my point is, There's a method to the madness. And okay, so then sanctions. So UK, United Kingdom, he came out today, talked this morning, saying, okay, they're going to sanction Russia with targeting 5 banks. They're one of the largest banks. So 5 banks are then targeted with sanctions, and then there are a handful of the billionaires within Russia. Okay, so that's UK's way of handling that.
Are they mafia members?
Probably. And then German Chancellor Scholz. So he's the new chancellor that took place of Merkel.
Yeah.
So Chancellor Merkel, who left last year. But let's go back to Merkel. So she passed, and France did some of this too. Again, just talks about the wokeness going on back then and still now. But the point is this. Germany halted production and their efforts for natural gas and nuclear power. So, okay, as they did that last year, and then they have like almost 45% or so roughly of energy, gas coming from Russia, I give this chancellor credit. He's halting the certification of the pipeline, which is that Nord Stream 2 that Biden granted last year, which he shouldn't have. But that's how it all started. Gave him the ammunition, the power to get back into, hey, we're okay. We're going to be on the offensive. So that's why Russia brought in the troops in March and April of last year, amassing all that all year long, and then all this comes around. But you can always point back to where it all starts and its weakness. I'll leave it at that. So with that said, more volatility near term, next few weeks, month, what have you, but that too shall pass. But we're all over it.
Yeah.
And I guess maybe takeaway as far as gentlemen that I follow a lot, and you've heard of him too and use him, is Larry Williams. So Larry Williams, and you'll see this, folks, but I just want to read to you his points. I was on a webinar past week or two ago. His point is this: the market always has corrective pullbacks and sharp declines. So corrective pullbacks, 5% or more, sharp declines, what you see in a day. Mm-hmm. They turn into painful, long-lasting ones only during times of recessions. We're not in a recession. No. We could be if the Fed tries to raise rates 5, 6, 7, 8 times, but I don't think they're going to be able to do that. So that's point one. Then number two, the other point that Larry Williams mentioned is the economy is not the stock market. So we knew that, but the stock market can be hurt by the economy. That's what we're seeing right now. Quad 4 curling over. Yes, stock market is being hurt by the economy and other geopolitical things that are going on. So major bear markets have taken place in recessions only. Yeah. Only in recessions, okay? Yep. So sell-offs outside of economic recessions almost never accounted for more than a minus 20% loss, but has swiftly recovered. So you're going to have, S&P, I believe, was down 8, almost 9%, could we go to 15% loss? Yes, okay, but it can turn around as long as we're not in a recession. It can bounce back as well. So
sure.
I just wanted to point those out. I know we covered a lot there, but go right ahead on maybe a little historical sunshine stuff.
Yeah, that's right. Yeah, it's never fun, right? When we go through times like this, it causes some anxiety. I know. Correct. For a lot of people, just checking your accounts out, seeing all the bad news out there, but it's all perspective, right?
Right, it's all perspective.
We know investing is not 1 month, 2 month, 3 month, 1 year. This is not. Term. Yeah, exactly. So I would say, unless someone all of a sudden they need all their money in the next couple of weeks, just to try the best you can to kind of block things out and not.
That's why you have us. We worry for you.
Yeah, so we
position it and we get ahead of it as best we can.
Yeah, exactly. Yeah, and so part of that is just it's a long-term game. It's diversification. Yeah, the S&P is down, the Russell's down more.
15.
Yeah,
QQQ's down 14, 15.
Yeah, technology.
Soon to be 20.
Technology, NASDAQ, and that's why when you have a diversified portfolio, right? We have exposure to the Russell, we have exposure to the NASDAQ, so it's gonna ebb and flow. But to give you some just historical perspective, that the S&P 500, just looking at that, the positive and negative years, I believe this is up to from last year, from 1926 to 2020. There have been 70 positive years and only 25 negative years. So nice. The positive years accumulation return or an average, annual rate return 10.3%.
I like those odds. Yeah.
Yeah, exactly. Yeah. So that should help. And then also just staying the course with, if you look at years like, hey, we've started the year out, things are down. it's sometimes, people might be thinking, hey, I just want to throw the towel in. But again, just to offer some perspective, in 2003, the S&P was down 14% and then finished up 26%.
Nice.
And then you have years.
Good recovery.
Yeah, you have just different years where the market was down, but you have positive years. And so it's just, again, where we are anticipating things, coming back, more in the second half of the year. Mm-hmm. So it's just being being focused, riding the course. The probability of positive returns over a 10-year time frame is 97.3% positive returns. So again, it gives people a little bit of hope or a little bit of sunshine. And
that all came from where?
This is from First Trust. Yeah, so one of our research partners. Right. We have a few of their funds in our portfolios as well. So. Yep. So again, it's the turtle and versus the hare, right? It's a turtle.
Boom.
Turtle wins the race. So
that's what I live by.
Yep. Yeah. So we are, the accounts, again, rebalanced. Dividends. Bonds are getting hit a little bit right now too. So, but it's just we'll get through it.
Yeah.
And we'll live to fight another day. But just keep focused on the goals on the long term. Some other bright housing, right? Yes. It's a bright spot. So. The Schiller Index, National Price Index, was up 18.8% over last year.
Dude, we should have sold. Why didn't we?
Yeah.
Where do we go? Live in a van down by the river?
That's right.
And I live in a van down by the river.
That's right.
Cash out on the high.
Yeah.
Oh well.
Yeah. So housing, I mean, it's just going gangbusters still.
Is.
So that's great. That's good. That's a good sign, right? So that's what we want to see. And I know, for going back to First Trust, this just came out this morning. Their target price at the end of the year on the S&P is 52.50.
Yeah.
That's good. I mean, that's optimistic.
So we're in the 42 range right now. Yeah. So it's 1,000 points more, folks, for the S&P.
Yeah. And so for the Dow, it's 40,000.
Oh, okay, yeah.
So there are, what is it, 32, something like that. I don't know.
S&P is more important than the Dow. I don't care.
But they are,
Yes.
Yeah, they realize, we are where we are right now, but they're optimistic.
Good news, back half of the year. Just got to hang in there.
Yep.
Grin and bear it. It's not fun.
Yeah, and then, yep, exactly. And of course, oil, we got, taking vacations at the wrong time, right?
Yeah, it looks like I might be able to finally take one this year, and I'll be driving. Dude, I think I followed up. I told you last week, $66.
Yeah, I know.
For my car, like the most. I'm like, really? God, that's. Anyways, okay.
Yeah, and cars. I mean, the price. That's another. This is supply stuff.
Over,
supply stuff works out, but still, it's like, okay, if I'm gonna buy I can pay. $24,000 for a used car, or pay $26,000 for a brand new car. Right. It's like it's just.
I'm with you.
It's all dropper walled right now, but
yes,
as that works out,
Oh yeah. Just a few other charts you'll see here. This is just the S&P stock market PE ratio. Historically, going back from 1980, it's been 15.5 historical average, as you'll see. The latest, this is through the last data point, is February 15, is 20.3. So it was close to 25. It's down to 20.3. Yeah, so basically, it's come in 5. So so as the markets come down, things are getting cheaper, more attractive, and eventually things will move back up again. So I do want to put that in perspective.
That's right. All those funds, all those investments we have set up on dividend reinvestment.
Yes, amen.
They're buying cheaper shares at lower prices. So that's good for everybody.
Yes, it is. Yeah. Then in regards to the VIX volatility, so I know we've hit on this a lot, but again, historically average is 18.2 going back to 2010. The latest as of February 18th, that was Friday, I believe, is 27.8. Today, before we just came in, I wanted to look into this. So the range on hedge eye risk range there, 34 in the VIX as a short end. Today we just crossed over 30, so it's called the F bucket. That's all I can say. You can use your imagination. So the chop bucket is 20 to 30. That's its volatility. And it gets over 30. It's called the what bucket. Nothing does well. So that's what we're heading into probably for the foreseeable few days or whatever until all this gets settled out a little bit.
Sure.
But there'll be opportunity as well. So I just wanted to everything in perspective. Then in regards to, remember the pullbacks, we talked about that. Last year there was one. Ding, 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 ding. Remember I said earlier we have a handful this year. We're already at 2. So 2 months in, we already had 2 5% pullbacks, and there'll be plenty more of those. Yep. So I wanted to put that in perspective. The average, again, for pullbacks is 4.5 times a year. You have a 5% pullback. We've had 2 year-to-date already, and plenty more to come. Next chart I do want to hit is the 10-year, 2-year. This is big because if it inverts, it's a leading indicator for a recession within 9 months or so. There's a little lag time, 9 months to a year. But anyways, again, this is data points February 18th. 2-year, 10-year. The 10-year 1.92 back then. I think it's higher today. Like safety, so I believe it's 195 or something like that. But the 2-year 1.47. So you see the spread. It's tightening up. It's narrowing. So if the 2-year, as the Fed starts raising rates in the short end of the yield curve, the 2-year then could possibly surpass the 10-year on what the yield is. It's called an inversion because the short end of the yield curve is earning more than the long end of the yield curve, the 10-year. 2 years longer than the 10-year, inverts, recession. Boom. Okay, it's 99% of the time, that's a leading indicator to we're watching that. So that's why I'm pretty adamant about the Fed cannot raise rates 6, 7, 8 times or whatever JP Morgan and those Goldman Sachs folks are saying. Anyways, and then here's the yield curve spread, the 10-year, 2-year, the spread recessions. So again, the spread between them has narrowed down to 0.45. Again, that's the latest from that, 0.45. It's the 0.100 if it inverts, voila, and recessions are great out there as well. So the average is 0.93 spread. So I'm going to round up to a 1% spread. So typically you have almost 1% spread between the 2-year, the 10-year. Right now it's 0.45, and soon to get narrower as the Fed starts raising the short end. So that's what we're all over at. And again, learned all that in T-Row when I was in the fixed income trading floor, so that's why I speak pretty heavily on that. The dot plot, again, the Fed, you can see here, again, the Fed wants to continue to raise rates, multiple times. We'll see if they're going to add a full percentage point this year, but you can see a projection of 2023, 24, they want to get to 2.5%, sooner rather than later. Okay, good luck with all that, but yes, they're behind the curve as they always are. That's the Fed. Wage growth, you and I hammered wage growth all year long. There's no inflation, transitory. Okay, whatever, they missed that. So inflation. Wage growth, 6.9%. This is January this year, 6.9. The average, from 1990 to 2010 is 3.3. Average from 2010, more current, it's 2.8. The point is, let's call it 3%. So we're more than double that wage growth. And once companies give those wage growth increases, they cannot take it back, folks. And it gets passed down to us, we the end user. Everything's gone up. So one last chart. In regards to the CPI, again, we talked about this. CPI is 7.5%. This is data through January this year. So that's and then the core excludes food and energy. Which I don't even know why they exclude it, but the point is, elevated 6%, 7.5 is CPI. Again, highest since the 80s. So I just want to rattle off a few of those charts. I know we covered a lot today. Take a breather. All right, folks. So
you're excited coming in today.
Oh yeah, I was. Anytime I see red, you know me, Andy. I love when it's bloody out. That's the alpha we. Remember I said we're going to add alpha this year. This is the year. So a diversified portfolio. We'll do better this year. So want to end on tips of the month or anything else you want to?
Just taxes, right? Coming up.
Taxes.
1099s are out. Everyone should have their 1099Rs, 1099 composites. If not, they can reach out to us. You can get them on the website.
Schwab. They have to push them out by the end of February, which is this week. So you'll get them
I think most of them have gone out already.
Yes. So you'll have that. Yeah, taxes is big.
No extension this year, right? So it's back to April 15th.
April 15th, that's correct. Yep.
RMD is still 72.
Yep, 72 for now, and then trying to get 73 and move it up.
They're always
tweaking all that. And speaking of that, for those of you, if you want to make your contribution to your Roth or traditional IRA, you just have till April 15th of this year. Well, don't cut it so close, but you can make a contribution this year and up to like April, let's call it, for last year if you're eligible and all that good stuff. So keep that in mind. And I'll just end with maybe aging in place. So with my folks and what's going on, personally, I can just, that's why we have Cindy Page, great for senior advisors and senior living as a consultant.
Yeah.
This is a stat came from Hedgeye back in January. Basically, it just says here, I'm just going to read it to you, a fully 88% of Americans age 55 plus want to stay in their home for as long as possible, hence, AKA, aging in place. So I'm living that right now with my folks. I've tried in the past to try to get them out of their house over the years.
I thought that was like on the couch watching TV.
Age of place, yeah. Remote, popcorn. No. But so yeah, I mean that speaks volumes. No, people want to stay in their house as long as possible. So keep in mind, we have Cindy Page. She's done great. A lot of work for our clients, even for my own family personally, and my aunts too.
Likewise,
for your clients too. But my parents, we just got them a stair lift. So up the staircase there, just a chair lift. It's awesome. Put my girls in it. They love it. They're going up and down. You can put laundry on it, food, whatever. So it's a great way just to relieve. So my parents are so much happier now.
They have a NASCAR sticker on the side. Put a number on there.
Daytona. Is that great? You know me. I was in heaven over the weekend, Daytona. I know, but it was good. So yes, racing's back. So Indy, NASCAR, all the good stuff. Formula One will be starting here. But anyway, so so let's just keep that in mind, folks. I'm a big believer, and I'll refer you to a firm that we use off Treby Road. So my dad was actually born in a house on Treby Road, Little Italy there.
Oh, nice.
So so we went back to there, and these guys did a great job installing. And
that's great.
So for those folks who are questioning, hey, it costs a couple $1,000s, but it's well worth it. It gives you so much more freedom. My mom has a L3 little pinched nerve, fractured nerve, so it just immensely took off the pressure for her having to carry things, etc. So
that's great.
Keep all that in mind, folks. We appreciate you. Right?
Yes, very much.
And then we'll see you next month. Stay well. Hopefully it gets a little warmer next time we get back together. I'll have my hair cut finally. Get off my whip.
Yeah, me too. Yeah, been saying that for.
I know.
Yeah.
All right. Well, hang in there. Stay well.
Have a great day. Thanks.
Talk to you later. Bye.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss.